In light of the risk-on, risk-off behaviour of capital markets that has persisted since 2008, investors are now looking at new ways in which to protect their portfolios and ultimately preserve capital. Following the risk-on rally that began at the end of Q3 last year, views regarding the future direction of asset prices are once again polarised. Interestingly, this has coincided with the general decline in the level of implied market volatility, or put simply, one measure of the market's perception of forward-looking risk. This, whilst few resolutions have been found over many key issues. It is a logical argument, therefore, to suggest that today could represent a value opportunity to buy protection for one's portfolio in the form of optionality. However, the implementation of such strategies in practice requires more careful attention. An assessment of the relative value of upside versus downside protection, or put another way, the supply and demand dynamics of puts versus calls in the open market. This is well illustrated recently by the skew prevalent in the volatility curve that shows a significant distortion in the shape of the curve that is driven by a strong demand from the investors for downside protection on headline indices. This has a rational grounding. Underlying managers like the bottom-up story of their companies from a fundamental grounding, yet they are less confident about how to price or discount risk at the macro level. Such risks are less about the so-called black swan events and more about a series of known unknowns. These can be economic and fundamentally driven, such as uncertainties over the growth outlook for China, or the impact of a prolonged high oil price on global growth. Or they can be systemic in nature, such as the impact of a default in the European periphery or the threat of military action against Iran. Hence, the value argument for simply buying put protection to complement an aggregate portfolio of traditionally held long assets is more easily challenged. In this context, in addition to a desire by investment banks to seek out more alternative ways to generate revenue, has led to the increase in popularity of tail risk hedging strategies and volatility trading products. Indeed, it is sensible to consider the possibility to outsource what is a highly complex and specialised skill set to a third party. It is essential that such products are able to deliver on their investment mandate by delivering protection for investors when it's really needed and ultimately delivering value for clients. It also must be acknowledged that such products are not without risk, and it's important to understand the risk reward at play when selecting which strategy to choose. Furthermore, there can be technical considerations to note, particularly where such products are structured in a closed-end format, whereby notes can easily be bid up in the open market purely through demand. At Ersel, such techniques are never going to be a core component of what we do, but where appropriate, can complement our existing multi-manager approach. Diversification has never been more important, and where possible, volatility strategies can assist us in this regard. Furthermore, we can look beyond headline asset classes to less traditional assets for hedging purposes. These can include options on pro-cyclical currencies in FX, short-term fixed income securities, and also commodities. The key for us, like any hedge, is to understand the sizing of this position within an overall portfolio, and that is the most important and challenging aspect that we face.